This episode is brought to you by Plaid. Plaid helps lenders approve more creditworthy borrowers without taking on more risk, combining real-time cash flow data with behavioral insights. It's a fast, familiar experience people trust and that actually converts. Learn more at plaid.com/FTT. Hello, and welcome back to the Fintech Takes podcast. This is a special emergency edition of Fintech Recap with Jason Mikula. We don't normally talk to Jason multiple times in the same month, but we made an exception in January because Jason did an extraordinary amount of reporting work on a company that probably has crossed your radar, a stablecoin-based neobank for Venezuelan consumers and small business owners named Kontigo. I just gave you the sort of charitable description of what you might call this company. There are other less charitable ways you could describe this company, which is exactly what Jason and I's podcast conversation, breaking down his extraordinarily great report, is all about. So without further ado, here is a special break glass in case of emergency episode of Fintech Recap with Jason Mikula. This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go. Okay, we don't normally do this, but when the news dictates, we are willing to do a special bonus edition of Fintech Recap. International reporter, Latin American sanctions evasion expert, man of mystery, hiding from people who want to, I don't know, serve him lawsuits, or I'm not sure what's going on in your world anymore. Mr. Mikula, it's great to see you. Of course, I am referencing a fantastic report that you published. How many words was it? Remind me.
It was about 5,500 words, and I apologize to everyone who had to work their way through that.
You know, what's funny about it is you had given me and a few other people a heads up about like the length of it, and like, this is a crazy story. There's so many different parts to it. And so I was anticipating like, oh man, I'm going to have to carve out a significant portion of my Sunday to read this. It actually read pretty efficiently. Like I kind of got to the end of it and I was like, wow, that 5,000 words went fast. And that's just because it's that crazy of a story. Of course, we're talking about Kontigo, the, I think it's fair to say sanctions evasion as a service, I think is something that I wrote at one point when I was writing about them. So, Jason, I thought what we could do for this episode was to have you kind of walk us through everything that you learned. And obviously, there'll be lots of points for discussion. I might have a couple kind of process questions for you because putting together a report like this is a ton of work, and I know you put a lot into it. So first of all, congratulations on the piece. It's wonderful. And second, why don't you kind of step us through the main pieces of the story?
Yeah, absolutely. So I think, it's important to set the context. And also, I mean, there's a couple of things that I just like personally want to clarify. It is a very complicated story. So that folks who are actually interested in, all the details, I would encourage them to go read it.
For sure.
It's also important.
And we'll put the link in the show notes in case anyone hasn't seen it yet. But yes, definitely go read it.
It's also helpful, though not strictly necessary, to have some historical context on Venezuela. There was actually a pretty decent New York Times Daily on this topic on Tuesday, January 13th. It's actually an interview with the same reporter who I cite in the story, who's sort of the Times Venezuela experts. It's definitely like high level and very sort of like Americanized focus, but it gives some historical context. It's also important to know that AML is not the same thing as sanctions, right? I think people who do not spend all their time thinking about this, which includes me, often conflate these things in like kind of one bucket. People will sometimes use the term fin crime, which, these do both fall under financial crime. Anti-money laundering before 9/11 was really emphasizing collecting data for law enforcement. It was after 9/11 and after some of the reforms and changes and sort of tacking on that CFT, the countering the financing of terrorism, that AML became more about trying to prevent financial crime and prevent terrorism. Yep. Sanctions is quite a different thing in the sense that it is a geopolitical and a public policy tool that we are relying on, that the government is relying on financial institutions to implement. So it's related, but it is a separate thing. And to be clear, the story is not arguing, and I am not personally arguing, that sanctions as a policy tool are necessarily a good thing. You know, a lot of the reaction and debate in Spanish language Twitter, which, full disclosure, I don't speak very good Spanish, which is embarrassing for a lot of reasons. But Google Translate works very well.
It does.
You know, a lot of the sort of pushback or criticism I saw amounted to, you know, if you're Venezuelan and you don't have other identity info, you're functionally cut off from the rest of the world's financial system. And by extension, yes. And by extension, if there are apps or services or tools, and to be clear, like Kontigo isn't the only sort of mechanism that's facilitating this. You know, crypto broadly, stablecoins broadly, facilitate this in Venezuela, in other, you know, countries that are either comprehensively sanctioned, like Iran and North Korea. You know, so it's not, you know, unique to this situation. But the pushback was kind of like, this is fine because it's the only option. And I'm not unsympathetic to that argument. You know, sanctions, you know, can and do inflict severe hardship on the citizens, the everyday people of the countries that are subject to them. But two things can be true at the same time. And, you know, sanctions are the law, are the regulation in the United States. And by the way, U.S. persons, this is not just banks. U.S. persons, whether or not they physically reside in the United States, so that includes companies incorporated in the U.S., that includes me as a U.S. citizen who's not physically located in the United States, are legally bound by these sanctions. So it's like, I do have like quite a lengthy segment in the piece that kind of walks through the history of sanctions in Venezuela. It helps to sort of explain and understand why a app like Kontigo became achieve product market fit, I guess you could say. Sorry. Yeah. Okay. So with that like long bit out of the way, last thing, I also just want to make explicitly clear, I reached out to, I think, essentially every company mentioned, including Kontigo and its very, very online co-founder, CEO, Jesus Castillo. So I think there were some tweets suggesting that I had not contacted the company. That's categorically false. Yeah. Okay. So with that out of the way, do you want to know what Kontigo purported to do?
I would love to know that. No. So, I mean, everything you said, I'll just give a +1 to. I mean, obviously, I saw the pushback, and we can talk more about this later, too, that happened afterwards. But I'm glad you clarified the point about reaching out to him. That's standard practice. I know you do that. Obviously, you have screenshots of doing that. So, you know, that's not untypical when companies are upset about coverage after the fact to sort of frame their objections in that way. We also talk about maybe some other reactions that happened after the piece. But I would love it if you could start with kind of an explanation of what they purport to be. Because to be honest with you, and I'm not part of their core product market fit, obviously, so I had only become aware of them, I think once you had started kind of the process of reporting on them, mostly due to the fact that they have some really bombastic marketing that kind of just made its way into my orbit. But beyond that, it was never even totally clear to me what the product was trying to do and then how I was supposed to square that with, again, that like very bombastic Jamie Dimon, we're coming for you type marketing. So yes, would be great to get an overview of that.
So the user-facing app, or from a user perspective, like it's honestly pretty simple and pretty straightforward, right? If you are, what was in the website changed over time, but I'm going to speak more to the reality than necessarily like what was on the website at any given point in time. And the reality is, due to the increasing sanctions, by the way, starting under President Obama in 2015 with the goal of like protecting human rights and democracy, which clearly has not turned out well, it became increasingly difficult for anyone to access the Western financial system.
Sure.
And so from a user perspective, what Kontigo offered is pretty simple and pretty straightforward. It allowed users in Venezuela to receive USD funds from outside of Venezuela, which were then converted to USDC, which my understanding is that is basically happening via bridge, but like let's asterisk that because like there's a lot of different infrastructure players and it becomes a little ambiguous what role each party is playing. But there were a couple of different mechanisms. Bridge allowed users to move funds from places like Venmo, Cash App, Airbnb, OnlyFans. There was for a time, and we're going to talk more about how this happened later, but there was a JPMorgan Chase bank account. So users had a routing number and an account number affiliated with JPMorgan Chase that allowed them to receive deposits the same, as you can send to any other ACH, wire, what have you. And they could hold these funds as USDC, and then as needed and when desired, off-ramp them to Venezuela's local currency, the bolivar.
Sure.
Why would you need or want to do this? I think given the amount of coverage about Venezuela in the past 2 or so weeks, people are probably broadly familiar, but the currency has been the economic situation has been wildly mismanaged. Hyperinflation is a real problem. The currency doesn't hold its value. So people want a secure, safe store of value, the US dollar, or in this case, a US dollar denominated stablecoin.
Right.
So basically, you could hold it as USDC, and then you could move that into a local Venezuelan bank via their main rails, which are Pagamóvil, which I understand to be kind of like a Zelle, or a bank transfer. And then spend those locally. There's actually a TikTok video that Kontigo posted where Jesus, the CEO, demonstrates this, and he off-ramps to Banco de Venezuela, which is an explicitly sanctioned bank on the SDN list, which is a fun fact.
That's a good one. Yeah, right there in the video. Yeah, I remember seeing that.
Post the evidence online. The company also offers a debit card. This is a little bit more confusing because it's not totally clear where, based on the user's KYC info, who is doing the issuing. So I used non-US and non-Venezuela identity credential, and the card was issued by Rain using its Puerto Rico money transmitter license.
Okay.
But it's not, I did not have conclusive evidence that cards were being issued to people using Venezuelan identity credentials. I would asterisk that and point out that, like, depending on how thorough that process is, if you have a stolen identity that's not Venezuelan, like, it probably would still work, right? I will pause there. Do you have any questions about, like, the core functionality that this was providing to, like, what I'll call retail users?
Yeah, no, I think it makes sense. I mean, obviously, the context is that if you live in Venezuela, there's a decent chance that you're trying to interact with other financial systems outside of Venezuela. And you listed some of them, right? Airbnb, OnlyFans, Venmo. Like, you're probably either transferring money, you're getting paid as a contractor or as an employee. So there's a sort of money in from the outside world element to it. There is a money storage element to it, right? And that's basically safe store of value, USDC, avoid hyperinflation. There's an off-ramp to the local currency because the money needs to be used for expenses in Venezuela, presumably. And then there's, I I guess, both the sort of like digital app element of being able to off-ramp funds and be able to make payments, and then also a debit card, which would be a way of also making payments or essentially off-ramping money to be able to be used. Did I get that roughly correct in terms of summary?
Yeah, absolutely. And I mean, I think particularly the debit card. I mean, imagine you live in Venezuela, but you want to pay your Spotify subscription or your Netflix subscription. Whatever. So like there are, transactions where you really do need like an internationally accepted card payment. You can't be using directly anyway, paying in USDC or some of these other mechanisms.
Right. So you're kind of like, you're flexing between international money in, international payments out, domestic money, presumably domestic money in, domestic money out, and being able to also store funds segmented away from kind of hyperinflation. Okay,
correct. Sorry, I should have added this to the context section. Zelle is widely used in Venezuela. Like this is known. This is not like a secret thing. I think the thing that people pointed out to me is, in order to get access to Zelle, either you need to be wealthy enough that you can go physically to the United States and open a bank account that has Zelle as a feature, or you need to be using an account that's maybe somebody else opened in a different name. And so, to use one of my favorite words, I guess Kontigo was democratizing some of these capabilities.
Sure. Well, I mean, stablecoins are great for sort of being a bridge, no pun intended, to these places without having to physically open up an account in the US. So I think it's useful context. And I will just maybe circle back and hit a point you made earlier, which is sanctions have a sometimes economically devastating effect on the lives of ordinary Venezuelan citizens who have nothing to do with the reasons that sanctions are put on a country or set of corporations or government in the first place. And that's the point of them, right? Like if they don't inflict economic pain on citizens, they don't work. And I think your illustration of how this product works, and even how like a Zelle or some other things would be used, just sort of speaks to the level of like desperation and going around any obstacles that you have to construct a reasonably effective financial life. Like it speaks to the situation that Venezuelan consumers are in, that's what drives product market fit for a product like this. So I think that makes sense and is useful context.
Yeah, absolutely. I mean, now there's a question of what was really happening behind the scenes that facilitated this business model. And I think particularly one of the things that, sources flagged to me, honestly, going back months, was essentially these numbers don't make any sense. Like, how could they possibly, already be at a 10 million annualized run rate? How do they think they're going to be at $100 million revenue annualized run rate like 3 months later? The take rate, which is the revenue as a percent of transaction volume, doesn't make sense. Yeah. These were some of the issues that people were flagging to me back in like October. Do you want to hear how they were doing that?
I would love to hear how that was happening, because this is the like behind the scenes, behind the product stuff. So yeah, please.
Actually, I have a question. Have you ever traveled somewhere that had strong like capital or currency controls? There are not really that many places in the Western Hemisphere that do.
My travel has not taken me to any of those places.
Mine has. I guess. So something that happens in countries when you have these kinds of capital and currency controls is deviation between what the government says the exchange rate is and sort of what I don't actually like the term black market, but what the informal market rate is. Okay. So for example, when I went to Argentina, which, basket case economy forever, but I don't think people necessarily think of as like, a police state kind of regime the way that people may conceive of Venezuela or perhaps Cuba. Like when I traveled to Argentina, there was the official rate. And if you put your ATM card in a machine and withdrew money, you would get your dollars into Argentine pesos at that official exchange rate. If you came to Argentina with $100 bills and went to the right part of Buenos Aires, which was just like open, an open sort of money market in the street, you could exchange into Argentine pesos at a significantly more advantageous rate. And sort of that mechanism is sort of what we see illustrated, arguably like orders of magnitude more severe in Venezuela, owing to this sort of like history of sanctions and the shortage of dollars into the economy that has caused. So, fun fact background. I think the high level piece, and this is coming from New York Times reporting that I cite in the piece from last October, as well as a couple of reports from an organization called Transparencia Venezuela, which is a chapter of Transparency International. Like the high level objective, as I understand it, at a government level or a nation state level, is we have oil. Most of Venezuela's oil is sold to China. China needs to pay us for that oil. Sure. I'm obviously simplifying and reducing this. So China is paying Venezuela for this oil in various kinds of cryptocurrencies. And Venezuela needs a way to get that dollar liquidity injected into its economy, including at a retail level. And so there are two apps that are facilitating this, another one called Crixto, and then Kontigo. As far as what Kontigo is doing and how, and I should also asterisk, any claim the company is making should be taken with a huge grain of salt. So when they're talking about number of users, when they're talking about, revenue, we don't really have any reason to believe that data, but that's what they're saying.
And it's funny, right? Because I was thinking about that when I was reading your piece. There's sort of the normal Silicon Valley line, and then there's other things that you might do to juice the numbers and break the law, and both of those come into effect, right? A lot of people don't really tell you exactly the perfect truth on number of users, growth rate, revenue, run rate, blah, blah, blah. So that applies here, just like any other YC-backed startup, but also all the other things you're getting into.
Yeah. So I talked to, probably about 20 Venezuelans and Venezuelan diaspora, so people living outside the country. And one of the recurring themes was the best business to be in a country like Venezuela is buying dollars at the official exchange rate and selling them at the informal market rate, and rinse and repeat. So the very strong circumstantial evidence implication is, Kontigo holds a license from Sunicrypt, which is this defunct Venezuelan crypto regulator tied to a $17 billion scandal tied to the state oil company, PDVSA.
That was a crazy little side story in your piece that we probably don't have time to get into, but it is crazy for people.
There's a lot of lead up, but after the 17 billion oil scandal, that regulator Sunicrypt went under reorganization. Never has officially restarted, and yet both Crixto and Kontigo were granted these crypto licenses at the beginning of 2025. And so basically the concept is they were functioning to sell Circle, USDC, synthetic dollars into the Venezuelan economy. And the perk for doing that was that they got to arbitrage the exchange rate. So they could basically sell it at the informal market rate, but they were accessing this USD denominated liquidity, presumably either at the official rate, the official stated exchange rate, which as of Q1 2026 is approximately 330 bolivares to the dollar. Whereas in Kontigo's app, it's something like north of 500 bolivares to the dollar. So a very, very profitable business to be in. Gets a little complicated, probably a little bit boring. If people want more on that, they can go read. But Alex, my question to you. So we've talked about some of the infrastructure providers here. The four ones that are highlighted in the story are Checkbook, which honestly I had never heard of until actually your conference out in Montana, where somebody mentioned them to me.
Yeah.
Rain, which is a crypto cards as a service issuer, Bridge, and Stripe, which acquired Bridge for $1.1 billion. And that acquisition was completed in Jan 2025. So my question to you is, like, what is the responsibility of these first level infrastructure providers?
This episode is brought to you by Plaid. Approving more borrowers shouldn't mean blindly taking on more risk or adding more friction. The problem is that traditional credit data is limited, and cash flow data alone doesn't always tell the whole story. Plaid helps lenders see the full picture by combining real-time cash flow data with insights from the financial tools people already use every day. Those signals come back in seconds through a low-friction experience trusted by about half of US adults. That means you can approve borrowers who are stronger than their credit file suggests, spot risk earlier, and grow without loosening your standards. Learn more at plaid.com/FTT. You know, it's a really great question. And I actually tweeted about this, just kind of saying that, like, to me, that's where kind of the larger story is in some senses. I mean, it's interesting. And I'd be curious for your opinion on this, because it rhymes with banking as a service, as many things we talk about do, I suppose. But, you know, it's interesting because I think in a banking as a service context, there's a very clear, not always adhered to, but a very clear like line of responsibility, right? Which is to say that, like, you essentially, everyone kind of rolls up to the bank, and the bank is regulated. And the thing that is challenging to me about stablecoins and about stablecoins as infrastructure is it doesn't feel like there's that sort of same roll up that goes to some regulated entity, right? And so you have the same multi-layered infrastructure that you have in banking as a service, or that you have in lots of parts of the financial services ecosystem these days. You have this provider that provides this piece, but they plug in over here, and then these two things sit over top of this. Like, you know, it's infrastructure all the way down, and I think that's true everywhere, including in stablecoins. The difference is that at the end of the day, like in a banking as a service context, the bank is the one who gets in trouble. The bank is the single throat to choke. The bank has to be responsible for third-party risk, for fourth-party risk, for fifth-party risk. Like, all that infrastructure that goes many, many layers down ultimately rolls up to one entity that's responsible, and that entity is very closely supervised and regulated. The problem I have with this story in terms of trying to like answer your question is I can't figure out who that is in this example. And obviously, like you mentioned, JPMorgan Chase, they are kind of a very removed third or fourth party in this, in terms of how like structurally they seem to have been used, right? It's for giving people access to a sort of virtual account held at Chase for the purposes of, if you need a bank account to do X, Y, or Z, as someone living in Venezuela, not typically able to open up a US bank account. But like that was being opened through Checkbook and the sort of virtual account relationship that they had with Chase. My understanding, Jason, and correct me if I'm wrong, I think this was originally reported in the information, is that Chase sort of, I guess, maybe got wind of this or sort of realized that it had a problem based on like disputes that were going through there, or like chargeback ratios. So it wasn't even like financial crime or sanction list sort of screening functions that were sort of causing a problem from Chase's perspective. And I mentioned that just to illustrate that, like, if the core thing that seems to have been done wrong is sanctions evasion, which I think you just sort of walked through all of kind of the evidence for that, who was responsible for catching that? Who was responsible for, whose problem is that? You know, and it's not really Chase's, because they were just sort of like an ancillary service provider for this one little part of this larger app. It's, I guess, maybe arguably Circles in some sense, or Bridges in some sense, depending on like where the stable coins are coming from. but not like totally. It's maybe a little bit like Stripe or a Rain or a lead bank who might be the like actual issuer touching the card networks in terms of like the issuer relationship. But again, that's just for a component of it. So not a very like elegant or simple answer to your question, but like I'm trying to illustrate the thing I'm struggling with is in banking as a service, everything ultimately either rolls up to or revolves around the bank sitting at the center of it, even if they might not have direct visibility or line of sight or an understanding or a sophistication necessary to understand the arrangement they've entered into. In this particular case, it seems like you have the same level of complexity and multi-layered infrastructure, but without that center of gravity that everything kind of ultimately falls back on. And so it seems like there's kind of a gap from an accountability perspective, unless I'm missing something. What do you think about that?
No, I don't think you're missing anything. And to spell this out like a little bit more explicitly, so you mentioned the JPMC virtual accounts, which were via this intermediary called Checkbook. Rain was doing card issuing. Bridge was doing the stablecoin on-ramping, and Stripe, separately from Bridge, was doing merchant acquiring. And so to your point, it's like, okay, well, this thing like functionally looks and acts like a neobank, but there is no single bank standing behind it, right? Like, I'm impressed that we've made it this far without me saying the word synapse. But like at least in that BaaS middleware world, the model was such that an end user did have a legal and contractual relationship with the underlying bank. And so there was, at least conceptually, there was a very clear relationship and a line of responsibility, whether it's consumer protection, whether it is BSA AML, like whatever the issue is. Obviously, like that did not work perfectly because we saw like 15 or 20 consent orders between like 2022 and 2024 or something like that. But to your, I like the metaphor, like there was a throat that the regulators could go choke and be like, hey guys, like this is a problem. You should probably try to like fix this or think about this differently. Like in this situation, and I had people ask me this question, though, like, well, sort of who's responsible here? And to your point, I kind of shrugged and I'm like, everybody?
Right.
I mean, but you know, as any good group project leader knows, when everyone is responsible, nobody is responsible.
That's right. That's right.
And so it's like, okay, well, you know, Stripe are bad, merchant acquiring, like maybe they like misled us on sort of the onboarding flow. You know, merchant acquiring regulatory from a AML regulatory perspective. Is quite different than being a bank, if it applies at all. Check with Sarah Beth Felix on that. Stablecoin space, you know, I know that folks are talking about like, oh, well, stablecoins are regulated because Genius has passed. It's like, well, yeah, but like implementing regulations have not been formulated. And
well, and that touches on a really important point, which is like trying to think of the right way to describe this. Like you couldn't have a neobank without the bank behind it having a bank charter and being a bank, right? Like the regulated entity has to exist first, and then you can build the sort of complex infrastructure abstracted model on top of that regulated infrastructure. What's funny about stablecoins and crypto is we built the infrastructure first, and we're backing our way into the regulated entity that will supposedly be able to like monitor and enforce these things, right? So like just using Bridge as an example, as I understand it, Bridge has applied for I think it's a national trust bank charter, if I'm remembering right. And like they've applied for that, and that presumably will be a component of their role as an on-ramp and an off-ramp. And I think also eventually them like issuing their own stablecoin directly and being regulated under Genius. But they're not any of those things right now, right? Like they're not. There are no implementing regulations for the Genius Act. They're working on that right now. A lot of these companies might get some form of a bank charter right now, and then eventually be supervised by the OCC, but they're not right now, right? And so, like the Stripe with the Georgia charter for merchant acquiring, like that's a very narrow purpose charter that might not overlap in any meaningful way with the type of supervision that you would want to have to catch these types of risks. And so it just doesn't seem like, it seems like Chase is the only one that's actually like an honest to goodness regulated institution. And in terms of how they plugged into this complex infrastructure, they're very much on the periphery. Again, they only noticed when there were an unusual number of disputes. Like that suggests to me that in no way, like a hypothetical I was thinking about was how, like, is there a realistic alternative universe where this just never comes to light and this just keeps kind of churning along? And I think that's pretty realistic, right?
I mean, to use our Jamie Dimon cockroach comment, it's like, do we think this is the only one of these?
Right.
In the sort of summary of the story in the app, I do not think we touched on the just absolute insanity of the company and the company's founders' social media presence, which I can only describe as like unhinged.
Yes.
I'm talking like shirtless hype videos. You mentioned that like we're coming at you, Jamie Dimon.
Which is ironic because they were using Jamie Dimon's bank and opening virtual accounts and marketing that too, like making that a part of their pitch to Venezuelan consumers.
Fun fact, I'm pretty sure that post about coming at Jamie Dimon was after Chase booted them off. So I don't want to, correlation is not causation, but like,
oh, goodness,
there might be a link there.
Well, and it kind of, it touches on, and I want to maybe bring it back to one other component, which we didn't talk about, but they raised $20 million, question mark, from what we can tell.
More than that, actually.
More because there's a round before the $20 million round, right?
So I had somebody send me the PitchBook report, and it did indicate that in December 2025, a round of approximately 20 million, led by Coinbase, closed, and there was some earlier there was funding before that. So that part seems to be true.
Yeah, and no, totally, and I guess so. Like they raised $20 million plus. Coinbase led around. Obviously, they came through Y Combinator, so Y Combinator is on the cap table. And I just think that like this among the many problems you described, I don't want to gloss over the insane social media profile. I don't want to gloss over the hacking house or building house that they rented. Can you give me that?
I thought you were going to talk about them getting hacked, but that's a different.
No, we're going to come back to that. That's another part of the story. So, but like they rented out like a house to go build the MVP version of the product in. They, they were incredibly, unbelievably aggressive in responding to the story, and not just with you, but with the information when they published something earlier. Like they were, I think, in an automated fashion, posting like you will face legal consequences type responses, which I know you get a lot, but I don't think like Sebastian, the CEO of Klarna, who just retweeted your story, is maybe used to getting those responses. So it's kind of the most like unhinged version of like the Silicon Valley, never apologize, never back down. There's no such thing as bad press. Just keep building and ignore the haters sort of mentality, blended together with all of these other problems and challenges and infrastructure screw ups and all these other things we've been talking about. Talk about the hack, because that's yet another part of this story that we don't spend a ton of time on, but it's notable.
I will have one follow-up on what you're saying, and then I will talk about the hack. I mean, I guess my honest to goodness question to whoever, did due diligence and onboarded them at Stripe, at Bridge, at Rain, at Checkbook is, did you not see any of this? It took me about 60 seconds of looking at their TikTok to be like, oh yeah, this is a big problem.
Got a problem,
60 seconds of reading on Reddit of Venezuelan users talking about using it. Like, if it's in Spanish, does it mean like you don't have to include it in the due diligence process? Honestly, it's insane.
That's as viable a question as any. And I will say, just to add to your point, that like, again, when banks look at this stuff, the first thing they look at is they look at like marketing materials. And it's like, if the marketing materials seem insane, walk away, right? And like, was there no one at any of those providers who was doing that? That's a great question.
And actually, to connect back to your earlier point of not having a single throat to choke, there may not have been anyone who felt they needed to look at that. It's like, okay, well, Lead Bank has exposure, but like Kontigo's not Lead Bank's customer, like their Bridge's customer. Stripe has exposure, but like merchant acquiring is like kind of a different thing. Like I have a merchant acquiring account and I've done that onboarding and it's pretty straightforward. Rain should have known better, but I hear there may be other cockroaches there. And like I said, Checkbook, I've never even heard of. Its use case is like kind of specific,
subtle, and very niche. Yeah. Mm-hmm.
But I digress. Okay, so the hack. While I'm in the process of like maniacally trying to research and put together this story and emailing with all the different companies and on the phone with people in the diaspora, Kontigo gets hacked. And I'm putting that in air quotes because it's not clear that this like authentically was a hack.
Right.
They report that just over 1,000 user accounts were compromised and about $340,000 worth of USDC are stolen, which the company then says it reimburses. A side note, because I am me and I feel the need to say this, that narrative was credulously repeated by Bloomberg, an American banker, with absolutely no scrutiny or questions about what was happening or why it was happening. And then in the following week, I think there was one or two more what the company described as like hacking attempts, with more videos about how secure they are and how they'll keep soldiering on, et cetera, et cetera.
Sure. The hackers, we know who you are and you'll face consequences.
Yes.
Yeah, pretty unhinged.
I mean, I think not that I should need to point this out, but the timing, aka immediately in the wake of the United States' I'm not even sure what word I'm supposed to use here, but invasion.
It's not an invasion because Polymarket says it's not an invasion because they won't pay that bet out. So you have to use a different word. Sorry.
Okay, shoot. Special military operation in Venezuela to arrest ? The Venezuelan president. This happened like days after that. Again, correlation is not causation. However, like if the rumor, and I will emphasize rumor from many people I talk to, is that this company is affiliated with the son of Nicolas Maduro. So, who is, by the way, charged in the indictment that
the son is.
The son is charged in the indictment alongside the now former president Nicolas Maduro and his wife. So, again, a lot of smoke. Something is probably on fire. It's like it's really not clear exactly what's happening. There have been sort of sources, people in my inbox who are more expert at blockchain analytics. I've not had enough time to dig into or engage in all of that. I mean, I will say, like, from an optics perspective, like if your global neobank is repeatedly hacked, which by the way is supposed to be self-custodial, which
that was multiple people used.
Multiple people told me that based on analysis of the app, it is not in any way that term is used in industry actually self-custodial. I mean, I know that you talked. Sorry, go ahead.
Can I just interrupt and say that the greatest quote of all time is the disclaimer at the bottom of their marketing materials that says, I think it says like BTW, Kontigo is not a bank. Banking services are provided by the freaking blockchain. And like, I might get that put on a t-shirt because that's amazing. But like speaks to your point about we call it blockchain when it's convenient, either to market it that way or to leverage capabilities of blockchain or stable coins that allow us to get around things that would otherwise not be possible. But then when you assume that it's blockchain in a way where it's like, oh, maybe the people who are stealing money can't get to my money because it's self-custody. No, 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 no. So like blockchain in the bad ways, but not blockchain in the good ways, kind of seems like maybe.
Evidently, I mean, the company's narrative was it is self-custody, but we don't expose the private key to you in the app because not everyone is familiar with how that stuff works. So we're going to abstract away that complexity.
AKA centralize it. That makes sense. That's fine. At that point, it's just a word you use. It's not in any way reflective of reality. But again, it kind of goes to it goes to this larger point, right? Which is that, like, how do you square the circle of having a banking app functionally, let's say, that can interact with other financial systems that otherwise would not be available because of sanctions, while at the same time being able to onboard a lot of users and accounts and wallets in Venezuela, a country that has very strict currency and monetary controls, while at the same time ensuring that the app is totally secure and is not subject to any, let's call it, pressure, attacks, government intervention, whatever we want to sort of maybe think of this hack in air quotes as. Like, I just don't know that you can square all those circles, right? Like, I mean, you can have some of those things, but you can't have all of those things. And I think, to me, that's like one of the sort of illustrative problems. You know, people in crypto talk a lot about, and in fact, there's a quote. I'll share it now just because it's relevant. But Brian Armstrong, the CEO of Coinbase, tweeted recently, a crypto wallet is an exit ramp from a failing local economy available to anyone. And like,
was that aimed at me? Is he subtweeting?
It might have been. It might have been. Honestly, I mean, didn't mention you by name, but boy, you know, coincidental timing. Just decided to share that thought. And Coinbase, again, investor in Kontigo. I mean, I genuinely think that there is a subset of people who work in crypto who really kind of believe that idea, right? And it's like this sort of like maximalist human freedom, no rules should constrain human happiness kind of view of the world. And I think that like that runs up against a lot of really difficult realities. Obviously, one is sanctions and being required as a U.S. company or a U.S. person or some U.S. entity or U.S.-based entity to follow the law, which requires you to, help the government enforce these sanctions. Runs up against that reality. It also runs up against the reality that, when you say, like, it's an exit ramp from a failing local economy, well, there has to be, just definitionally, that ramp has to be propped against that economy, which is run sometimes in a corrupt or overly controlled way by a government that might not like you offering an off-ramp onto that economy and might require certain conditions for you to participate in that economy and act as an off-ramp. Like, it runs up against a very on-the-ground reality, which I don't think a lot of crypto people tend to talk about, which is like the governments in these countries where you're going in and kind of parachuting in out of the goodness of your heart and rescuing these, consumers who, again, I personally feel bad for and feel for. Like, doing that is going to require some way of interfacing with that economy and with that government. And that lends itself to these kind of theories that we're talking about in terms of, Kontigo's ties to the Venezuelan government. Like, that's just another one of those messy on the ground realities. And it doesn't seem like Brian Armstrong cares to carefully interrogate like what that means and what those trade-offs are.
We're going way off the outline, but I have thought about this to some extent, and it's like that narrative, very, very sort of American centric narrative of like, like we're saving or helping the people in, X country, Argentina, yes, Venezuela, wherever, by giving them access to this crypto thing. And again, two things can be true at the same time. At an individual citizen or individual, business level in that country, the ability to interface with a financial system that maybe you otherwise can't, or to preserve purchasing power outside of your local currency. Like, yes, I understand that, like, that is a real benefit that people, need and will respond to and will seek out.
Yeah, well, and like a Venezuelan consumer has no obligation to uphold U.S. sanctions. That's not their job, right? And so, like, they're going to do what they're going to do to manage their financial.
I'm not even talking about sanctions, by the way. I'm saying, functionally, what that is doing is undermining the monetary sovereignty of the country that product is going into. So I mean, yes, the sanctions piece that we talked about, but I'm also saying,
you're right.
If you're Argentina and you're like, hey, like, there's many issues. Maybe maybe it's not a fiscal or monetary policy that, any of us would agree with, but like, if you're the duly elected leaders and you're saying, like, this is what we're going to do, but simultaneously a foreign company is essentially like providing, I forget, did he say exit liquidity? I feel like somebody tweeted that. Like, it will have very material and real economic consequences in the countries where people are doing this, particularly if it's outside of the sort of regulatory approach of that country. And again, I'm going to like beat a dead horse here. Like, these can both be true. Like,
oh, totally.
Is it good for that individual person? Is it understandable why they want that? Yes. But simultaneously, we weaponize the US dollar with, we being the United States, turned the US dollar into a geopolitical tool, with things like sanctions and SWIFT, that the direction of travel has only been increasing, right? As far as Venezuela is a great example, but also, Russia-Ukraine war.
Totally.
And, stable coins or USD denominated stable coins in a way sort of like represent the next wave of that. And that's not an accident, right? It's both a government policy, I would argue, and private companies like Circle and Coinbase that stand to benefit from it, which, by the way, private companies like Coinbase that sponsored certain people's military parades.
Yeah, no, I mean, I think everything you're describing is exactly right. And we don't have time to get into all the like market structure legislation stuff that's happening in the US, but it all kind of snaps together, right? In the sense that I think one of the biggest challenges, and I'm sympathetic to this, honestly, I think one of the biggest challenges with stablecoins is that they are simultaneously a whole bunch of different things, right? Simultaneously, stablecoins are financial services and payments infrastructure. They are a either tool for or a way to avoid sanctions and other types of financial crime enforcement. They are a soft power mechanism, potentially, to sort of reinforce the dollar's dominance globally. Like, they are a bunch of different things all tied together, right? And so from a policymaker perspective, like if someone is at Treasury and they're trying to figure out all these different pieces, like, I really sympathize with that person because stablecoins are not simple. But the thing that I find frustrating, and Kontigo is probably the most visible cockroach type example of this, but it's a much broader problem, is I don't really like it when private companies that have a very clear sort of economic interest in stablecoins boil it down to something much simpler than that and try to pretend like, oh, this is just about banks not wanting to pay you interest and we want to pay you interest, or this is just about creating, payment infrastructure for the 21st century because the payment infrastructure we have is antiquated and not fit for the era of the internet. Like, it is those things to a degree, but it's all of those things woven together. And when we say something like, well, maybe we should implement this particular restriction so that from a financial crimes enforcement perspective, we can do X, Y, and Z. Like, I don't want Coinbase flipping out about that and going like, you're trying to challenge the global freedom, global economic freedom of all consumers. Like, stop it with that. I mean, like, this is a complex topic. And I think Kontigo is a wonderful and honestly useful illustration of what can go wrong and what can break with this stuff.
Yeah, absolutely. I mean, a common phrase in crypto world is, that they're speed running X, fill in the blank of whatever they want to talk about that day.
Yeah.
And I really think that stablecoins are speedrunning BaaS, including, the bad part, or maybe especially the bad parts, and possibly, honestly, in some ways worse and or in a more risky manner, in the sense that, as we've discussed, there's greater opacity, or like you could also frame it as less responsibility because it is so diffuse over so many parties. There's also just a much smaller number of players, right? I mean, at some point, depending on how you defined it and who you asked, there were, over 100 banks playing in the BaaS fintech partner bank space. How many banks are playing in this sort of stablecoin crypto on-ramp? Like, not that many. The number of infrastructure providers is significantly smaller. So you have a much greater degree of concentration. And at the same time, as we've already discussed, you have the exact same kinds of TPRM, third-party risk management problems. Or I think it was Mike Su, one of his speeches where he talked about like nth party, because it's third party, it's fourth party, it's fifth party, like down the line.
It's a great way to put it.
And you still, for all of the like miracles of the blockchain, you still have the same kinds of reconciliation problems, because you might have your USDC floating around, but like somewhere there's supposed to be US treasuries and deposits that are backing those USDC. You still have this like intermediary layer, that needs to sort of do this like transaction tracking reconciliation as far as issuing, redemption, how people are using these stable coins. And not to sound like me, but you've also had a lot of crypto people migrate to the stablecoin world. And I feel like they just bring a very different mentality than what, certainly than you'd seen in TradFi banking world, but even than what you see in fintech. Certainly plenty of fintechs have like run into issues, but like generally, if by definition they had to work with a bank partner, like there were certain guardrails that generally kept things from going totally off the tracks.
No, it's a great point. I mean, I was thinking about, as we wrap up, like, what's the lesson that you want to take from this? Like, what does all of this mean? And one of the things I was thinking about is there's always a tension between the business that's trying to grow and the business that's trying to manage risk. And, I think that tension always exists and to a degree is healthy, right? So like, inside of a bank, there might be two groups of people who have different responsibilities. And one's the risk management group and one is like the marketing group, right? You used to work in this role with lending. And, so the marketing team would be like, an amazing campaign. Look at all these new applications. This is fantastic. Product market fit. This is great. And the risk people are freaking out because product market fit to the credit risk people means, whoa, did we miscalibrate our model? Like, this is growth that we didn't expect. Like, what the hell's going on here? And so you have tension between groups inside of a bank. And then if you expand it to like fintech, I think a classic example of this when neobanks were coming up was fraud, right? So like, the neobank would go, wow, like, look at this. This is great. Like, product market fit. Everyone's applying. This is fantastic. And the bank partner is going, are we sure that like all of these are legitimate customers? Is there fraud here? Like, what should we be worried about? But I think even in that scenario, the like red line that you didn't cross was, okay, maybe there's credit risk being taken that we don't like and we stand to have losses. Or maybe there's fraud here happening, but fraud is still just like losses that's going to hit the bank, or the bank is going to share the losses with the fintech company, depending on the arrangement. To me, like, stable coins push this to an entirely new level, which is some fly by the seat of their pants app way over here on one side and a set of kind of disintermediated or disconnected stakeholders or, third and fourth parties on the other side. No one's really looking at it. And the product market fit, and this relates to the sort of inherent natures of stablecoin and crypto, the product market fit, in the same way that, for lending, it can be credit risk is actually the product market fit that you're seeing. Or with fintech neobanks, the product market fit you can see is actually fraud. With stablecoins, it's money laundering, it's sanctions evasions, like it's financial crime in a much more kind of serious international way. And so, like, I guess the takeaway I have is with anything stablecoin related, like, be very, very afraid and just sort of like naturally suspicious of product market fit, because it could be very, very bad things driving that product market fit.
No, I mean, to reiterate that, and then we can wrap up with our regular what we can't let go of.
Yeah.
I mean, in any financial services product, if you see incredibly fast growth, it is a red flag, right? Whether it is a transaction product, a bank account product, certainly a credit product. And I think that anyone who has experience working in boring old TradFi, even me as a marketing person, right, understands that it's like, if we're, originating $1 jillion and we're exceeding all our goals, something might actually be wrong. Like, this might be a problem.
Totally.
And we've certainly
seen you learn
that,
to kind of cultivate that paranoia when you work in TradFi, right? Like that just, like, I mean, again, Chase figured out something was wrong because there was an abnormally large number of returns. That's a sign that there's a problem that's actually behind this growth that you're seeing.
Yeah, exactly. I could talk about this all day, but Alex, what is your favorite part of this story? What can you not let go of?
Oh my gosh. Well, I'm going to have to steal a different one because I was doing the Brian Armstrong quote earlier. I'll take as a second choice, my second draft pick, the fact that one of the founders, another venture that they had was starting a tequila business. This is a little...
It was an agave spirits business. Tequila can only come from Jalisco, so I apologize.
Look at you! That you really you should relocate, my friend. Okay, fair enough. That is very on brand for the sort of like insane behavior point that we were making earlier, and I think I might want to, as like an investor who doesn't invest in any of these companies ever, I might use that as like a negative signal, like, oh, so what other kinds of entrepreneurship have you done? It's like, oh, I started a new spirits brand. Oh, okay, well, we'll be passing. Like, I think if you had that rule, you'd probably be very successful as an investor.
As a very quick aside, I've actually been to Tequila. It was quite fun. And there's a train. I think there's actually more than one train. There's a Jose Cuervo train, and there I think is also a Herradura train, which is a different brand. Lovely, like, weekend trip. You can go around all the different distilleries.
That might be like a future FinTech Takes event, or FinTech Takes FinTech Business Weekly collaborative event, like tequila visit.
If I'm remembering correctly, one of the ones we went to was actually the one that produces like Kendall Jenner's or one of the other celebrity tequilas, because they all just like slap their name on it. But
one of the other, well, and the when you and I launch our own FinTech tequila brand, that's when people know it's time to like unsubscribe.
Speaking of branding, the piece of this that I cannot let go of is that Kontigo's logo very clearly and obviously incorporates and makes reference to the country's failed oil-backed cryptocurrency, the Petro, which you and I didn't even touch on that chapter.
Yeah.
But like, it is, just go look at it online, and it is obviously a reference to the country's failed cryptocurrency, which failed because there was a $17 billion oil scandal with PDVSA. So like, this is not subtle. Anyone who spent more than like 60 seconds looking on the internet should have been like, this looks sketchy. I should ask more questions.
Totally. Well, and again, the point you ended your piece on, which again, if there's anyone who hasn't read the piece, go read the piece. It's fantastic. But if you read the piece, you ended it kind of with that Jamie Dimon, when there's one cockroach, there's probably more quote, right? And relevant on a number of different levels, given Kontigo's network of partnerships that they had. But I think it also is just really important to say that Kontigo is like, I think I wrote about this. They're like the cartoonishly bad version of this, where it's like obvious within 60 seconds of looking at it. Like it should have been easy for anyone doing even the basic amount of due diligence, which seemingly didn't happen, to be able to realize something was off about this company and the founding team. For every one of those, there's a dozen, 2 dozen, ones of these that are more subtle in the problems that they have. And that's a lesson I took away from the banking as a service stuff, is that like Synapse and Evolve was the cartoon villain version of it, but there were lots of other structural weaknesses that were out there that were harder to spot, but are in fact there. And I think this tells us something similar about the level of kind of problematic design and implementation in this growing space.
We will have to leave it there and check in at our next regularly scheduled catch-up, where we have plenty to talk about.
We definitely do. Try to take a break from writing these like 5,000 word long pieces that necessitate a emergency fintech recap podcast. I worry about your mental health getting too sucked into these stories, my friend.
I will not do this to you again until at least Q2.
All right, that's a great place to end it. Thank you, sir. Thank you for listening to this episode of FinTech Takes. Stay up to date with emerging companies and the latest FinTech trends by subscribing wherever you get your podcasts. And if you love FinTech Takes, please tell a friend.